Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks are on pace for a record close on Thursday as the latest reading of inflation showed consumer prices ticked up in August and jobless claims rose to their highest level in nearly 4 years, helping set expectations for the pace of interest rate cuts this year. And on the back of rate cuts being all but assured, stocks rallied. In fact, it is far better for us to talk about the stocks that didn't gain today. Netflix was one of them. It fell 4.27% today after a downgrade from Goldman Sachs. A couple of the chip names were red. AMD was down 2.2% along with AVGO. These stocks right here were probably just giving some back. They had rallied over the last week. Oracle, very much the same, was up 40% yesterday, down 6% today. Palantir down 1.32%, and that was kind of it. A couple of the utility names, GEV was down and everything else was red apart from Microsoft and Nvidia, which were largely flat. But we saw software outperform, financials, comm services, Google, Meta, all of the healthcare names, consumer defensives. Today was actually just a risk-on rally. Every single sector gained, except for XLE, which was flat. It's in the red box right here, but XLE was actually just flat today. Gold, a safe haven asset, which was down 0.29%, showing us today was really a risk-on day with the S&P 500 gaining 0.79%, the Nasdaq 100 in excess of that. And you could see discretionary, materials, healthcare, financials, real estate, all up 1%, including communication services. Even staples was up 1%. The majority of sectors actually gaining in excess of 1%. It just goes to show how strong the rally was today. And it was broad-based. Mid-caps, small caps, they actually outperformed the large cap space. And you could see here that value outperformed growth, relatively speaking. At least in the large cap space, we did see growth outperform as well as core outperform value. Here in the small cap side, up both sides up 1.5%, but small cap value was still up 1.2% respectively. Mid caps as a whole just gained in excess of 1%. All in all, today was just a risk-on rally in large caps, small caps, in US stocks, but globally as well. We saw Europe stocks gain a lot. Asia stocks were very, very green. North America, South America stocks actually really, really bullish. The only countries that weren't bullish was Australia and New Zealand. Other than that, Middle Eastern stocks gained, South African stocks gained. It was just a bullish day through and through. Globally in the US, everywhere you looked, stocks gained today. And this came on the back of inflation data. Now, when you look at core inflation data, right, it came roughly in line 0.3 versus the consensus of 0.3 for the month-over-month figures. The year-over-year figures came in line 3.1% for the year, and actually inflation didn't tick up. So you can see the previous number was 3.1%. Core inflation came in exactly that. However, we did get a bit of volatility here in the headline figures, right? Now, the core excludes food and gas. Headline is just the aggregate inflation figure. That came in at 0.4%, right? The consensus was for 0.3, and that meant inflation ticked up from 2.7 to 2.9. However, the year-over-year rate came roughly in line, 2.9% versus the 2.9% consensus. So even though the month was volatile, we actually still got the 2.9% inflation figure, which is what the market wanted. And that set the stage for rate cuts along with initial jobless claims. That came in at 263,000 versus 235. Now, with initial jobless claims, we actually want a lower number, not a higher number. So it actually did miss expectations, as you can see right here, and rising from the previous number, which actually got revised down ever so slightly. So we are seeing the labor market weaken and inflation coming roughly in line, especially on the year-over-year figures for core and headline. This is going to give the Fed the opportunity to cut rates, and they're going to do that next week. The question now is it a 25 basis point cut or is it a 50 basis point cut? Because the deal is done. Rate cuts are officially done. Now it's the market pricing. I think the market may actually freak out next week if we get a 50 basis point cut. But if it's 25, I think that's going to set the stage for at least one more cut, according to Reuters, as you can see right here. But by my estimation, I think by the end of January, we should see 100 basis points worth of rate cuts to take the Fed funds terminal rate to 3.5% from 4.5%. And now looking at some market movers, Warner Bros. Discovery, ticker symbol WBD, jumped 30% on Thursday afternoon after there's reports that Paramount Skydance is preparing a majority cash bid to acquire Warner Brothers. This bid is backed by the Ellison family, according to the Wall Street Journal, and the market really likes this news. They want to see Warner Brothers acquired. The stock was up 26% as a result. Alibaba was up 7.5% after the company said it plans to raise $3.2 billion through the sale of zero-coupon convertible bonds. Alibaba said it would pay nearly 80% of the proceeds to expand data centers, upgrade technology, and improve services to meet AI demand for its cloud solutions business. Again, the market wants to see money piling into the AI trade, the data center trade. And when you see that, the market loves this. The stock is still really cheap, trading at about 12 times forward earnings. So if you're looking for an undervalued data center play that also has like the software business attached to it, this free cash flow generative, buying back shares, paying a dividend, Alibaba is where you want to be. However, you are taking on China risk. And then on the AI trade, some more moves that really did move the market was Micron Technology. Their earnings are coming up. They were up 8% after a Citigroup analyst, Christopher Denley, raised its price target to $175 from $150, maintaining its buy rating on the stock, saying that Micron will outperform market expectations at their earnings next week. And then for everything we saw today, there was 4,600 advances, 1,600 decliners, market breadth, extremely strong. Inflows, we saw outflows here in the Nasdaq and the New York Stock Exchange. However, if you measure the gap up, there was actually inflows in the market with the S&P 500 gaining 0.77%, and we've recaptured the 5-day moving average. This is very constructive, and we continue to be above the 50% mark. And this is why I continue to champion buying the dip, because market breadth, market momentum, and inflows continue to move to the upside. They continue to be in really healthy levels. And when that is the case, any volatility we get, buy those dips. And in times like these, you'll be buying the top for like 3, 4, 5, 6, 7 months in a row. It's exactly what we're seeing right now. Market breadth, market momentum, and market flows look very healthy, and expect very much of the same in the future. Now, looking at the charts, you can see a broadly green day for US equities across the board. Large caps gaining, but complete outperformance here in small caps. Look at the Russell up 1.5%, the equal weighted up 1.3%, mid caps up 1.28%, the S&P 600 up 1.69%. Very solid day through and through. Growth underperforming value, but just a solid day all in all. And it's not to say that large caps didn't have a great day. You take a day just shy of 1% any day of the week. Even international stocks were up. China stocks were up the most. We saw Indian stocks gain. And Middle Eastern stocks were kind of flat-ish. European stocks up 0.5 percentage point. Crypto, which again is highly sensitive to rate cuts, also very bullish. And that's just coming off their third bullish day in a row. Ethereum up 1.65%, Bitcoin up 0.33%. And it looks like the bottom is in. And I do think we're probably going to go higher. We'll talk about it a little bit later on. And then when we look at some of our macro indicators, we can see volatility down in a big way. The 2-year and 10-year yield fell, again, owing to rate cuts. Look at the 10-year yield at one point peaking below the 4% mark. The 2-year yield sitting at about the 3.5% mark. The dollar fell as well, down 0.3%, although I still think we're going to see some strength in the dollar. And then TLT was up, and then gold was roughly flat. Silver gained. All in all, a very crazy day, but definitely a risk-on day. We saw, a rotation from stuff like the dollar, from stuff like gold, right, into just US equities, particularly the equal weighted S&P 500 and the Russell 2000. Now, looking at the S&P 500 in aggregate, you can see that we are starting to approach overbought levels right here. So look, there could be a situation where we continue to move into overbought territory, and then next week's rate cut, right, becomes a sell the news event. That being said, we got roughly in line inflation. Jobless claims not that great. We're definitely getting a rate cut next week, 25 or 50. I'm still erring on the side of 25 basis points. I think if we did get a 50, we probably see maybe even a bigger increase in gold, but that isn't the case today. At least the market is saying maybe not a 50 on the table. That being said, when we look at the S&P 500, the weekly chart, this looks really strong. The weekly chart looks strong. It is approaching, these overbought territory right there. Not quite there just yet, but this isn't a reason to get bearish, because normally when you look at something like this, right, when we do peak our way into like overbought scenarios, if we stay in overbought territories, we generally just get this like grind up move, as you can see. So if we get into overbought territory and stay there, right, normally you can see market indices just like grinding to the upside. And I wouldn't even be surprised if we continue to grind up to like 66, 67, 6,800 for the S&P 500. Now, going to the daily chart, you see very much the same higher highs, higher lows here for the market coming off these tariff tantrum lows. We're going to go ahead and put on the moving average right here. And you can see that, we've been sort of just bouncing off the 50-day moving average after we broke above it right here. Not bouncing off it exactly, but, we've been sort of tracking the 50-day moving average to the upside. We're approaching the end of the range, as you can see right here. Guys, this is the gamma flip zone. So this is the gamma flip zone. They put support and the core wall. It's all based on the options market. So pretty much, I think we can actually see a little bit of a weekend rally to get to the top end of the range. Although I am starting to think that maybe sell the news event after next week's rate cut. It does look like the market has priced in a lot of that move to the upside here in this early part of September. And I wouldn't be surprised if we start to see seasonality do its thing next week as we officially get rate cuts and we do see a bit of a sell the news event. That being said, any volatility we do get in this market, let's say we do get a pullback in the S&P 500. This is just a dip buying opportunity. You want to buy the dip right here at the gamma flip, the 6,300 as well as the 6,200 if we do get there, because we will be moving higher. I think we see 7,000 sometime in 2026, and that would represent 10% upside from where we are right now. In fact, we did get this tweet here from JP Morgan. They said the S&P 500 could drop by 8% following the Fed's rate cuts next week. So that's something very, very interesting. So maybe they do see that, sell the news event, the writing on the wall. If we are to take a measured move of what 8% will look like, it will be a pretty dramatic fall. But again, nothing serious if we take a measured move from where we are. So that'd be 5% to right there. So 8% would take us roughly to the 6,000 level. That's what JP Morgan sees us falling. If that is the case, again, still a dip buying opportunity. Ultimately, we want to be buying dips in this market all the way to the 5,700 area. This is where things become a little bit crazy. But even if we fall another 8%, buy those dips because rate cuts are coming. The economy is actually stronger than it looks, and the AI trade is bigger than ever after Oracle's earnings and after what we got from Alibaba today, what we will get, AVGO, Nvidia. Everything is on track for us to continue to move higher, and that's going to be driven by tech names, and you definitely don't want to be short this market, or you definitely don't want to be underexposed because you will pay for it greatly towards the end of this year in 2026. Now, looking at the Nasdaq 100, guys, these are all-time highs for these stocks. The Nasdaq 100 hitting an all-time high. S&P 500 looking like it wants to close at an all-time high. If we actually go ahead and look at the Russell, right, that's a new 52-week high for the Russell 2000. That's an all-time high for the RSP. Again, if we close there, looking at mid-caps, that's an all-time closing high, not an intraday high. Sorry, S&P 500 mid-caps, that's a 52-week closing high if we close there. S&P 600, also a closing high if we close there, not an intraday high. But guys, these markets are looking really, really good. We're at highs, 52-week highs, all-time highs. And it's completely risk on, because when we actually look at gold was actually down today, only down 0.2%. So it's telling us, we're seeing a bit of risk on. We are seeing a bit of volatility here. And I do think we are going to continue to see that with gold. We are probably going to see a bit of a move down here with gold, find support, and then we'll continue to move up. Just remember that gold, rate cuts for gold is really, really strong. But that rotation from the safe haven of gold into equities upon rate cuts, that can see a little bit of near-term volatility, near-term downside for gold. So do expect that. I think if we do, if gold does continue to move lower, I think anything at about this 317 mark in the GLD, that's the ticker for this ETF, buy that because we probably will go higher. 4,000 gold, especially in the futures in 2026, probably what I see. We're at about 3,600 right now. The dip opportunity here would be at 3,400, and that would be 20% upside to get to the 4,000 level for gold. I'm also bullish on silver, but not quite as bullish on gold. I do like silver. I think if we get to this $35 area, you want to go ahead and buy that dip because silver will move onward and upward. Now, looking at Bitcoin, it does look like we've officially put in the slow. We're breaking above some of these key highs. I think we're going to see the 23,000 level for Bitcoin in short order. For Ethereum, I'm bullish. As long as we hold above the 4,000 area, all-time highs in play. It does look like we're sort of forming like a bottom right here, onward and upward for Ethereum. Again, 6,000 before the end of the year. At least that's what I'm betting on. Now, guys, what stocks are going to benefit the most from rate cuts? One of them is Lemonade. I think this is a good stock. It's pulled back. It's nearing support, as you can see, at this $47 area. I have $50 cash secured puts that will probably get assigned tomorrow if this doesn't shoot up tomorrow. But that being said, I really like this name. I really like Lemonade. Another name I do like is CoreWeave, right? You want to play the AI data center trade, go ahead and do it in CoreWeave. And I think this stock only trades at something like 8 times forward sales. It's not expensive, and I do think we're going to see all-time highs sometimes in 2026. And if we take a measured move as to where that'll take us, you're looking at 63% upside at minimum. And I think right now, CoreWeave's revenue backlog, or their RPO, is at about $32 billion, just under $32 billion. I think in 2025, this is going to be 50, right? Along with the fact that we're probably going to materialize about $5 billion of that. So to see their backlog growing as they bring more compute and some of this revenue online really goes to show, at least that's my assumption, but I do think that we're going to see CoreWeave's revenue backlog grow exponentially at the end of this year, 2026, purely on the back of what we saw with Oracle. Some of that money is going to flow into the rest of the market. So those are two names I would look at right now. Lemonade in the small caps. CoreWeave is a mid-cap stock, kinda-ish. I would say borderline large cap stock. And then if you're looking for a big mega cap stock that you do want to buy, I think Google is still a great way to play. I mean, look, obviously you want to wait for a pullback to maybe this 225 area. If we do get, let's say, that 8% pullback that JP Morgan is calling for, but if we do get that, I would go ahead, buy Google. A lot of the risk, especially the antitrust risk, is now pretty much out of the stock. And I do think we could see 250, 260, 270 for Google in very short order. Not an expensive stock, 23 times earnings. Google should really trade at a multiple like 30x. So those are the names I do like, guys. But all in all, equities look good. I think we do march higher, significantly higher. And any dips we do get in some of these names, you guys want to go ahead and buy those dips. For example, NBIS, right? Ultimately, on a day like this, where we get these dips, if we dip below the $85 area, potentially even get to the $75 area, this is a region where you want to go ahead buy, because we probably go ahead and break the $100 area. This is a key player in the AI trade. I personally like CoreWeave more than Nebius, but all of these stocks will do really, really well, especially if they're directly exposed to the AI trade. Guys, and diving into sentiment, this is the AA sentiment survey. And over the last couple of weeks, we've seen a very clear trend. Bullish sentiment ticking down, bearish sentiment ticking up. In fact, we are near the 50% mark. This is normally the levels where you start to see things turn. However, despite being near 50% in bearish sentiment, some of the highest levels we've seen ever, I think the highest ever is like 59%, right? This is coming on the back of weaker than expected PPI data. That's bullish. Core PPI data, as well as stocks near all-time highs, mid-cap, small caps near 52-week highs. This is definitely telling us that the rally we're seeing in the markets right now is the most hated rally. Ultimately, we want to be buying the fear, and it's very clear where the fear is right now. Investors, retail traders, American Association investors are very, very fearful. And the truth of the matter is, in the near term, that could materialize when we look at S&P 500 seasonality following a rate cut after pausing for 6 months. We can see a little bit of volatility in the near term. Can see a little bit of a move up, a big move down. However, that is just an opportunity to buy the dip, because we will ultimately go higher. And 12 months later, you're looking at returns of about 15%. What also could push us higher is buybacks. Buybacks through 2024 are some of the highest ever. And see gross buybacks minus issuance, net buybacks looking very, very strong. And however, we do have to pair this with the macro, and I think the macro is looking largely constructive. Economic growth is at about 3.1%. That's very solid. However, when we look at the annual job revisions, right, we saw much worse than expected revisions versus the original. And this is telling us the labor market is cooling and it is loosening ever so slightly. However, I do want to put a spin on this. When you get negative job revisions like we just saw, right, this can actually be very, very bullish, because when you look at output is equal to jobs plus hours plus productivity. If jobs aren't rising as much as expected, and we're still getting 3% growth, the difference is being made up in productivity. The AI trade is alive and well, and this is insanely bullish, because when we get rate cuts, and we are looking at a 90% chance of rate cuts this September, when we get those rate cuts, we're going to see rate cuts support the labor market through cheap capital. If we keep those productivity figures, you're going to see growth explode to the upside. Now, guys, we have the last bits of data before next week's FOMC. We have the Michigan consumer sentiment, and that's pretty much it. After that, it's really onto the FOMC. We probably get either 25 or 50 basis point rate cut next week. We don't really have anything on the earnings calendar, guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment.